Bismillahirrahmanirrahim. We'll continue with our lecture number 3 that we did last time. In lecture number 3 we discussed financial statements, cash flows and taxes, and in the last lecture I gave you overview or the theoretical concept of different things which are involved, important things which are related to the financial statements, some of the analysis that can be done, some of the key calculations that are involved, and that gives us an idea about the performance of the firm. So some of those we discussed last time, but we did not touch the numerical part. So today we are going to start with the numerical part first. So I gave you these practice questions. There are in this handout there are 10 questions. What I tried to keep them like a very basic question, or they are not very complicated questions. The idea is just to clarify whatever concepts we studied in theory last time. We'll move with the first question, which is about book value per share. Anyone who want to describe what is book value per share? What is the idea or how we can calculate book value per share? Anyone?
So basically the organization defines a value for a share. Basic price, initial price per share.
Okay, book value per share is basically what is the value of share as it can be calculated from your financial statement or from the balance sheet. So what we do in calculating book value per share, we take the value of total equity and divide it by the number of shares. So that is how we can calculate book value per share. So book value per share is common equity divided by number of shares of common stock. So number of outstanding shares. So number of outstanding shares of a common stock. So we can calculate book value per share by dividing this common equity, total common equity, by the number of shares. Now in question number 1, it says Bauer Software current balance sheet shows total common equity of 5,125,000 dollars. The company has 5,30,000 shares of common stock outstanding, and they sell at a price of $27.50 per share. This $27.5 per share is the market value of the share. It is the price that is offered for a share in the market. By how much do the firm's market and book values per share differ? So we have to find out the difference between these two values. The market value per share is 27.50. Market value per share is $27.50, and we have to find out the book value per share. We can find out book value per share by dividing total equity, which is 5,125,000, divided by number of shares outstanding, and the number of shares outstanding are 5,30,000. So this gives us book value per share of 9.67. So the difference between these two values will be the difference between book and market value. Difference between book and market values. $17.83. So that is the difference between book value per share and market value per share. It means that the share is being sold at a much higher value as compared to the book value per share.
ये जो शेयर में डिफरेंस जो आ रहा है प्राइस में, this is because of the passage of time, this difference increases, और ये शुरू में ही डिफरेंस रखा जाता है by purpose.
Basically, market value per share is the
Initialization हुई होगी तो क्या 9.67 हुई होगी?
it might be the price might be closer to it might be closer to the book value per share, the price at which the share is issued, but later on, depending upon the demand of that share in the market side, like people, the perception they have about that company, now since they are ready or willing to purchase at a higher price, this push the price of the share up. So that is the
Facebook का अपन $10 का एक शेयर करेंगे $90 में.
right. So because of the performance of the company or the returns the shareholders are getting or they are expecting, because of that there is this variation.
Book value is actually the initial.
No, book value is actually how much it worth. How much it yes.
It can change with passage of time.
It will change, right? Because book value per share includes your original value, like whatever was the price at which you issued the share, plus it includes the retained earnings. So as retained earnings keep on increasing, this value will keep on increasing.
So it will keep on increasing.
This book value will also keep on increasing, but ultimately your market value will also be increasing in the market. Okay,
so it could be that the initial value of this share could be somewhere around $5.
Right.
And now it has gone up to 9.67.
That might be possible. That is also this. That is also possible.
The equity जो है, just equity जो है, it will not remain fixed.
No, because there is an element of retained earnings included in it. So retained earnings will keep on increasing. So which will push your equity up.
Every year they will retain some earnings.
That will add to that.
But equity can it be in form of property?
Balance sheet,
Equity usually.
All your assets, I think.
No, basically equity is like common equity is your shares which you have issued to the common stockholders. So whatever price they have paid for that, that is your common equity. Ultimately it will be converted, that amount is transferred into property.
Actually, I think so. This common equity, in my opinion, would be the initial value what the company got by offering its shares in the market, and then adding on the retained earnings.
Right. So it will keep on increasing.
Adding on the retained earnings.
Okay. Second question also is related to the same concept, book value per share. In question number 2, Brown Fashions Incorporation, December 31, 2012 balance sheet showed total common equity of $4,050,000 and 200,000 shares of common stock, 200,000 shares of stock outstanding. During 2012, the firm had 4,50,000 shares of net income. During 2012, the firm had $4,50,000 of net income and it paid out $100,000 as dividend. What was the book value per share at December 31, 2012, assuming no common stock was either issued or retired during 2012? So again, we have to find out the book value per share.
plus the income.
Right.
Minus the dividends divided by total income.
Okay, whatever was the common equity at the start of the year, we have to add net income into it and deduct the dividends. So that will give us addition to retained earnings. That will give us the new common equity that we have to divide with the number of shares outstanding.
This equity at the start of the year?
Yes, $4,050,000 is at the start. Like this does not include the profit of 2012. This does not include the profit of 2012. So question number 2, we have to find out book value per share. So total common equity divided by number of outstanding shares of common stock. Now, in order to calculate this total common equity, we have common equity as on 12/31/12, $4,050,000. Now, during 2012, there was a net income of 4,50,000. Net income 4,50,000. Out of this net income, there was dividend of 100,000. So we have to deduct those dividends, less dividend. 100,000 dividends are paid. So remaining, like the difference between these two, net income minus dividend, is your retained earnings. These retained earnings are 3,50,000. So this retained earnings will be added in our this balance of common equity. So we have to add retained earnings for the year 2012, 3,50,000. So this gives us a total common equity of $4,400,000. Now we have total common equity of $4,400,000. Total common equity. So we can calculate book value per share now. $4,400,000 divided by the number of shares outstanding are 200,000. So book value per share is $22.
Like in question number 1, it says current balance sheet shows total equity of so much.
Right.
Question number 1.
Right.
In question number 2 also says balance sheet shows total common equity of so much.
Right.
So how do we come to know that which common equity is at the start of the year and which common equity has added the retained earnings?
Okay, if there is no other data given, like if no other, if it says that the common equity at December 31 and there is no other data given, then we'll take it as the ending common equity. But if other data is given, like the net income for the year is given as well as the dividends are given, then we have to assume that these are not included into the common equity. So we have to incorporate those net income minus dividend, which is our retained earning. We have to incorporate that retained earnings in our common equity, total common equity.
So, I'll make a point today. Common equity is the amount which you earn by selling your shares. That goes wrong in this case. It means this is the amount which you have put in your business.
No, actually it is what you have sold your shares, and then every year you keep on adding your retained earnings. Now, like for instance, on 1st January 2013, in this case, the total common equity will be 4,400,000
Next year.
next year. And then at the end of 2013, the retained earnings will be added into this. Is it like this?
Right. So it will keep on changing.
It will keep on adding. Or if there is any
Total common equity includes retained earnings.
So equity means only that amount which you earn by selling your shares, nothing else.
No, again, total common equity includes two things.
The point where it starts, the first equity which you get, it is by selling your shares.
That is the first equity, but with the passage of time,
You may add on money in form of retained earnings. That retained earnings may come from the profits, or maybe from you put in more money in your business.
now if you put in more money, that will become common equity. That will also be added there. But if it is coming from the profits, that also will be added in your
Say if I sell my share and I earn, say maybe in this case $1 million US dollars, and I put in from my side $3 million more, so and then my common equity will be $4 million US dollars, not 1 million. So it means this is the money which you are putting in your business, not the only from the shares.
No, but in case of corporations, it is not the individuals, it is the shareholders. So shareholders will... Common equity is in case of shareholders, right? The shareholders cannot put the money directly into the business. The only way they can put in money is by purchasing the share. That is the only way.
By the other types which we have, let's say,
Then it will...
business or the...
Then it will be on sole in case, yeah, in that case, it is... That is a separate case. Okay, then another concept that we studied was net operating working capital. Last time we discussed net operating working capital. Anyone who can define what is net operating working capital? That is working capital. Current assets minus current liability is working capital.
Net operating working capital says current assets minus
net operating working capital. So we can say this is NOWC. So
this is the
current assets, right? Minus what?
Minus current liabilities plus notes payable.
Minus non-interest bearing liabilities. Current assets minus non-interest bearing liabilities. Non-interest bearing liabilities include your account payable and accruals. These are non-interest bearing. So they will be deducted from your current assets and you will get your minus non-interest bearing liabilities.
What are the non-interest bearing
Liability, account payable and accruals, because both of them, they do not involve any interest. Account payable and accruals. Account payable are basically your credit purchases. Once you are purchasing from someone on credit, that is account payable.
You already paid amount.
No, you have to pay in future, but it does not involve any interest. Whatever you have purchased, for example, if you have purchased for 100,000, if you pay after 30 days or 60 days or 90 days, it does not. You have to pay 100,000. It will not involve any interest. Same thing applies with the accruals, like if it is salaries payable, outstanding expenses, any outstanding expense. If it is rent payable, interest payable, so whatever is outstanding expense, that amount you have to pay to the, it does not involve.
Accounts payable and notes payable. Accounts payable you have to pay back in 90 days.
Usually it is. Notes payable can be long term. They can also be short term, but they are in writing and they involve interest. Notes payable involve interest, but account payable does not involve interest. Account payable does not involve interest. Right. Notes payable are written loans, like whenever you are getting loan and that loan is against some legal document. So legal document means there is the amount of loan mentioned in it, the amount of interest is mentioned in it, and the due date is mentioned in it. So you have to go by that document. In case you delay your payment, if you are not able to pay on time, in case of notes payable, you have to pay extra amount in the form of interest, which is not the case of accounts payable. Like accounts payable, even if the supplier has told you to pay in 30 days, you delayed your payment, you paid after 60 days, still you will pay the principal amount, you will not pay anything extra.
Notes payable would be your current assets?
No, liability. Payable, anything which include payable is a liability.
It's a liability, but this is non-interest bearing liability.
Non-interest.
It is interest bearing liability, so it should not be here.
Yeah, it should not be here. Interest payable, note payable should not be there. Okay, now in this question, it says Prez's company's balance sheet showed total current assets of $4,250, that is the current assets, all of which were required in operation. So these are all current assets which are required in operations. Its current liabilities consisted of $975 of accounts payable, $600 of 6% short-term notes payable to the bank. Since it is short-term, that's why it is included in the current liability, but it involves 6% interest. And $250 of accrued wages and taxes. What was its net operating working capital? So for calculating net operating working capital, the data is given. We have the current assets of $4,250. These are the current assets which are given. Now we have to deduct non-interest bearing liabilities. So we have accounts payable, which is $975. Accounts payable of $975 plus another current liability of accrued wages and taxes, which is $250. So 4250 minus $725.
It should be 11.
Sorry, we have to add these two.
1225.
12,
25.
25. So our NOWC is 3025. नेट ऑपरेटिंग वर्किंग कैपिटल इज जी जी हाँ उसने टोटल ले लिया तीनों को ऐड किया फिर माइनस किया तो बात तो वही हो गई उसने तीनों को ऐड किया और उसमें से फिर जो नोट्स पेबल को माइनस किया वो उसने काम वही किया सिर्फ उसने तीनों को ऐड करके फिर उसमें से
वो उस सूरत में हो सकता है कि अगर वो क्वेश्चन if there is a question it says that the total current liabilities are
Right.
this much,
ठीक बिल्कुल ठीक है मतलब अलग अलग डिफाइंड नहीं थे
then you have to minus the
एग्जैक्टly
percent the interest rate.
बिल्कुल एक चीज जो इंटरेस्ट बेरेंगे वो उसमें से माइनस कर बिल्कुल ठीक
So all you have to do is actually over here you have to, whichever has an interest on it.
राइट करंट लाइबिलिटी
That in the current liabilities
for
NOWC.
NOWC purpose, right?
Only for NOWC.
Only for this purpose. Okay. Now we move on to next problem, which is about EBIT. EBIT stands for earning before interest and taxes. Earning before interest and taxes. Rao Construction recently reported $20.5 million of sales, $12.6 million of operating costs other than depreciation, and $3 million of depreciation. It had $8.5 million of bonds outstanding that carry a 7% interest rate, and its federal plus state income tax rate was 40%. What was Rao's operating income or EBIT in millions? So for calculating EBIT, earning before interest and taxes, first thing that we need to see is what is the sales. So the total sales are $20.5 million. Out of this, we have to deduct our operating expenses. 12.6 million is the operating cost. So if you deduct from the sales your operating costs, how much is this amount? 20.5 minus 12.6.
20.5 minus 12.6.
7.90 is our EBITDA, earning before interest, taxes, depreciation and amortization. From this we have to deduct our depreciation, less depreciation. How much is the depreciation? It is $3 million. So deducting depreciation from this amount give us EBIT, or it is our operating income, which is $4.90. Okay, so once we are preparing this income statement, from the total sales we have to deduct the operating expenses. This gives us EBITDA, which is earnings before interest, taxes, depreciation and amortization. In this case there is no amortization expense, only depreciation expense is there. So from this EBITDA we have to deduct this depreciation, which is $3 million. So the remaining is our earning before interest and taxes. There is no amortization in this case. Yeah.
They are not given.
None. Usually, in most of the cases, the companies don't have any amortization expense. Generally, they have only fixed assets. So on fixed assets, what they charge is depreciation. Yes, then we have to add DA. Then we have to deduct both depreciation and amortization. Both added together will be subtracted from this.
Sir, does this mean that operating expenses are the sales minus the cost of goods
And other
and any other expense? What are those other expenses over here?
Other than cost of goods sold, like any selling or administrative expenses will be included there.
So company expenses.
Right. All the expenses will be included.
Expenses of the company.
Right. They will be included here in operating.
So, operating expenses means the total profit.
Operating expenses, those which are essential to run your business.
Operating costs.
Right. Operating costs.
Operating costs are your profit.
No, they are not profit.
Because once you deduct the cost of goods and the other expenses, whatever is left is your profit.
That gross profit, you can say, right?
That's your profit. Because whatever the company is selling, if they deduct their cost of goods plus their company expenses,
Right. But we have
their profit.
what we have done is we have classified some out of those total expenses we have excluded some expenses. Those expenses which we have excluded are these interest, taxes, depreciation and amortization, because they are also expenses, but we have excluded them. So you are right, they are profit, but minus these. Right. Okay, now another question in which we have to prepare the full, you can say, sort of income statement, in which we have to calculate earnings before taxes, or the taxable income. Question number 5 is about EBT, earnings before tax. So in question number 5, we have to calculate earning before tax. Brown Office Supplies recently reported $15,500 of sales, $8,250 of operating cost other than depreciation, and $1,750 of depreciation. It had $9,000 of bonds outstanding that carry a 7% interest rate, and its federal plus state income tax rate was 40%. How much was the firm's earning before tax? So in this case we have to find out EBT. Again, the sales are given. Sales are 15,500. So there is sales of 15,500. From this sales we have to deduct the operating costs. Operating costs excluding depreciation. $1,750. So this gives us EBITDA. How much is this? 15,500 minus 1,750.
It comes out 13,750.
Sorry, this operating cost is 8,250. This is not 1,750. 8,250 is the operating cost. So 15,500 minus 8,250. How much? $7,250 is the EBITDA. Now from this we have to deduct the depreciation. Less depreciation expense. 1,750 is to be deducted. This will be 5,500.
5,500.
And this is our earnings before interest and taxes. From this we have to deduct the interest expense less
7% interest of 9,630.
interest. Now this interest is
7%.
there is a bonds payable of 9,000 and 7% is the interest. So this is $630. So interest expense 9,000 is the bonds and the rate of interest is 7%. So 7% of 9,000 is 630. This interest expense is to be deducted. Once we deduct interest expense from EBIT, we get EBT, which is 4,870. Earnings before tax 4,870. So this is earning before tax or the taxable income.
In case of any such question, we have to do all these steps like this, or can't we just straight away write that okay, EBT will be the sales minus operating cost, depreciation, because we are calculating EBT. Operating cost, depreciation, and interest.
Yeah, you can.
Put the value over there. Or no, we have to follow this.
It's fine.
How easy
Even if you want to do like that, yeah. Even if you want to do like the other way, that's fine. Whatever you feel comfortable, you can do like that. If you want to put it in this format, you can do it with this format. If you want to do it like a straight line formula, you can use that. Doesn't make any.
How the tax वाले how they will determine the taxable income? वो तो sales के ऊपर ही होती है.
ना सेल्स के ऊपर होगी वो आप अपनी उनको रिटर्न जमा करवाएंगे ना कि हमारी टोटल सेल्स इतनी थी पूरे साल की उसके बाद वो जो भी आप उसमें से एग्जाम्पशंस यू क्लेम योर एग्जाम्पशंस कीजिए हमें इस पे हमने ये एक्सपेंडिचर किए हैं लेकिन इसके अलावा हमने सर्टेन एग्जाम्पशंस आर देयर फॉर एग्जांपल आपने वेलफेयर के लिए कोई काम किया है या किसी और ऐसा कोई और एक्सपेंडिचर है जिस पे गवर्नमेंट आपको
कैलकुलेट करेंगे इसमें तो we have deducted the operating cost.
This is from the company's point of view, not from the tax department's point of view.
This calculation that goes wrong. You don't have to pay this taxable taxes. ये जो निकले हैं 4,800.
No, this is the amount. This is the in this
Before taxes.
right.
Taxable income. Income which is subjected to the tax.
This is subject to the tax, right?
But other way around, sales are subject to tax.
No, not the sales.
That sales tax.
Profit is subject to tax, not the sales. So for calculating profit, you have to give your expenses as well. Just like in salaried class also, when you...
The sales tax, that's a different thing.
That is another thing, yeah, sales tax.
Probably sales is even higher than this point.
Right. Sales tax is different, वो अलग है, वो 6% या जो भी है, वो अलग चीज़ है, वो तो उन्होंने जमा कराना ही है, but this is income tax, this is on their profit. ठीक है.
So, you mean to say that when they present a company, a corporation, they present their document for tax to the taxation department, actually they give this earning, which is the taxable income.
Right.
They say that, okay, this is our earning before tax, this is our taxable income.
Yeah, this is the amount which should be subject to tax.
Subject to tax.
Probably, once we purchase goods, how much is the sales tax and how much is the income tax?
No, sales tax is defined. 6% is almost 6% or something is the sales tax. That is different. That company has to pay. But then,
like company mobile card,
हाँ.
charge the tax in advance.
In advance.
Tax by कुछ नहीं है.
बिल्कुल ठीक है.
There is some percentage which is the sales tax and the कुछ
अब इस तरह आप किसी रेस्टोरेंट में जाते हो, they write GST, general sales tax.
General sales tax.
16 or 17%. They charge you that. They actually charge the sales tax which they have to give to the taxation department. They charge it from you.
Yes.
That is the tax which they charge from you and give it to the taxation department.
And that is not actually the tax of that business. That is your tax that you are paying. Now that
you are paying.
वो तो आपकी जेब से जा रहा है. तो that is the difference.
ये वो tax.
ये
के ऊपर टैक्स उनकी जेब से जाएगा.
वो तो बीच में मिडिलमैन का रोल बस प्ले कर रहे हैं. जो बिजनेस वाले हैं वो आपका टैक्स लेके उनको जमा करवा रहे हैं. लेकिन ये वाला टैक्स उन्होंने खुद पे करना है. That is the tax they have to pay. Okay, another concept that we discussed last time was free cash flows. Any idea what does this free cash flows, FCF, means? Free cash flows. Free cash flows are the cash flows which are left after all the necessary expenditures which are required to run the business, they are paid, or even the capital expenditure. It includes the capital expenditures as well. So capital expenditures plus all the other expenditures which are necessary for running the business, those expenditures are deducted from your net income, and whatever is left over is your free cash flow. So this cash is actually what can be used for any purpose. Surplus. This is the surplus cash. Plus depreciation. So now the formula for FCF. EBIT 1 minus T plus depreciation minus capital expenditure, which is capital expenditure plus whatever change in NOWC is there. EBIT 1 minus T, what is this thing called? इसका एक और नाम भी है. This is NOPAT. Net operating profit after taxes. EBIT 1 minus T is NOPAT, net operating profit after taxes.
So this is in fact EB
Earning before,
earning after tax.
yes, right.
Earning
After tax, net operating profit after tax. Okay, now the question says, Vesudavan Incorporation recently reported operating income of $2.75 million, depreciation of $1.2 million, and had a tax rate of 40%. The firm's expenditure on fixed assets and net operating working capital totaled $0.6 million. How much was its free cash flows in millions? Okay, so the EBIT is given, which is 2.75. 1 minus the tax rate in this case is 40%, so 1 minus 0.4. 1 minus T, 1 minus tax rate. Tax rate is 40%, so 1 minus 0.4. Depreciation is 1.2 millions. Then from this net income we have to deduct the capital expenditure plus net operating working capital. Both things are given, the firm's expenditure on fixed assets and net operating working capital total 0.6 million, so 0.6 million. FCF of 2.25 millions. So free cash flows of $2.25 million. Again, it is a non-cash. We want to, whenever we are calculating free cash flows, so for free cash flows, for cash flow purpose, depreciation is added back because it is a non-cash. There is no cash involved. This is an expense. So for calculation of income purpose, it has to be included, but for purpose of cash flows, it has to be added back. ठीक है, खर्चा एक्सपेंस तो है, मतलब अगर आपने इनकम को डिफाइन करना है फिर तो आप उसको इंक्लूड करेंगे, लेकिन अगर आप कैश फ्लोज की, हियर वी आर कंसर्न्ड अबाउट कैश फ्लोज, वी वांट टू फाइंड आउट व्हाट आर एक्चुअली आर कैश फ्लोज, कितना कैश हमारा आ गया, तो दैट्स व्हाई वी एडेड इट बैक, डेप्रिसिएशन को हमने वापस डाल दिया उसमें. चेंज इन नेट ऑपरेटिंग वर्किंग कैपिटल, यानी लास्ट ईयर हमारा कितना था और इस ईयर कितना है, तो वो जो चेंज है दैट इंडिकेट्स कि हमें कितना कैश चाहिए था एक्चुअली, कितना हमारी रिक्वायरमेंट थी. ठीक है, तो वो कैपिटल एक्सपेंडिचर हमारे कितने थे और हमें कितना वर्किंग नेट ऑपरेटिंग वर्किंग कैपिटल रिक्वायर्ड था. तो ये दोनों चीजें मिल के अगर आप इन दोनों चीजों को ऐड कर लें तो दिस इज द एक्चुअल कैश वी रिक्वायर्ड इन दिस ईयर. इतना हमारे पास कैश, इतना हमें हर सूरत में चाहिए था. ठीक है, तो वो हमने माइनस कर दिया फ्रॉम ऑल आवर इनकम. अब जो बच गया हमारे पास वो हमारा वो कैश है जो हम किसी भी पर्पस में यूज कर सकते हैं. दैट इज फ्री कैश. दैट इज द कॉन्सेप्ट ऑफ फ्री कैश फ्लोज.
अभी इसमें इंटरेस्ट भी शामिल है.
बिफोर इंटरेस्ट एंड टैक्सेस, हाँ इंटरेस्ट भी शामिल है.
इंटरेस्ट पे नहीं किया तो फिर फ्री कैश फ्लो में वो तो पे करना आपको इसमें.
टैक्स माइनस, हाँ इंटरेस्ट इसमें शामिल है, राइट. वो तो वो आप उसको फ्री कैश फ्लोज में से वो भी आप कर सकते हैं. दैट कैन बी यूज्ड. फ्री कैश फ्लो कैन आल्सो बी यूज्ड फॉर रीपेमेंट ऑफ इंटरेस्ट, जो उसमें शामिल है.
So what is the basis of this EBIT bracket 1 minus T?
So
When it is
we are
before interest and tax, if we just minus tax from this, it will be interest after tax. The net operating profit after tax.
so right. That's the same thing.
But why 1 minus T?
सर वो परसेंटेज में है ना टैक्स, वो मल्टीप्लाई हो.
मतलब टैक्स को आप माइनस कर रहे हैं, इंटरेस्ट को माइनस नहीं कर रहे हैं. That is why it is 1 minus T. So from EBIT, from earning before interest and taxes, we are adding back that. We are not we are taking out the tax but not the interest. Interest उसमें शामिल है लेकिन टैक्स उसमें से माइनस हो रहा है.
टैक्स देखना सर, टैक्स क्या होता है? 40% ऑफ द अर्निंग. तो आपका सिर्फ 1 मिलियन EBIT है, उस 1 मिलियन का 40% आप निकालेंगे, it would give you 40,000. So you will subtract from 1 million the 40,000.
But we are putting the tax rate over here. We are not putting.
No, that is, हाँ नहीं, 1 minus T का मतलब है ना टैक्स रेट माइनस करेंगे ना. 1 is
1 minus 0.4.
We are actually making the.
तो हम इनकम का 60% ले रहे हैं, नॉट 100%. 40% तो हमारा टैक्स कट जाना ना.
Now the
ये तो सेविंग बचत.
हाँ
मतलब it is simple EBIT minus the tax.
राइट,
EBIT minus the tax.
बिल्कुल माइनस द टैक्स.
EBIT minus the tax.
माइनस द टैक्स, दैट इज व्हाई इट इज कॉल्ड नो पैट.
No PAT is actually EBIT minus the tax.
बिल्कुल ठीक. सही है.
नो पैट में इंटरेस्ट शामिल होता है.
नो पैट में
No PAT में
इंटरेस्ट शामिल है.
It becomes EBI.
Okay.
No PAT becomes EBI.
Okay, next question is about MVA, which is market value added. Right? Market value added is what is the value added in the market price of the shares during a particular year.
book value
Huh.
and difference of the book value and market value.
Right. That is the market value added. So question number 7 is about market value added. So the formula for calculating market value added is market value of equity minus book value of equity. So the difference between these two values is our market value added. In this question, over the years, O'Brien Corporation stockholders have provided $20 million of capital when they purchased new issues of stock and allowed management to retain some of the firm's earnings. The firm now has a $1 million shares of common stock outstanding, and it sells at a price of $38.50 per share. How much value has O'Brien management had added to stockholder wealth over the years? That is, what is O'Brien's market value added? Okay, so market value of equity minus book value of equity.
MBA stands for
Market value added.
Market value added. Okay, market value of equity. First we have to find out market value added of equity. This can be found out by stock price multiplied by number of shares. So we have a stock price of 38.50 multiplied by number of shares outstanding, which is 1 million. So 38.50 is the market value of the share, price per share, and 1 million is the number of shares. So our market value of equity is 38.5 million. 38.5 million, whereas the book value is 20 million. So the difference between these two is 18.5 million. Market value added is the difference between the market value, current market value of equity, and the book value of equity. Current market value of equity we can find out by multiplying the current price, stock price, with the number of outstanding shares, whereas the book value of equity means whatever is the amount received in the form of sale of shares plus the retained earnings. So that is already mentioned in the question, that stockholders have provided $20 million of capital by means of purchasing new shares and stock, as well as allowing management to retain some of the firm's earnings. Azan ho rahi hai? Okay, we will have a break for namaz and then come back to continue. Problem number 8 is about net income. Again, calculating net income, how we can calculate net income. That is question number 8, net income. So the problem says Emery Mining Incorporation recently reported $150,000 of sales, $75,500 of operating cost other than depreciation, and $10,200 of depreciation. The company had 16 $1,500 of outstanding bonds that carry a 7.25% interest rate, and its federal plus state income tax rate was 35%. How much was the firm's net income? The firm uses the same depreciation expense for tax and stockholder reporting purposes. Okay, so we have to find out the net income in this case. Again, same formula will be there. Sales. The sales are given, which is $1,50,000. Operating expenses excluding depreciation. So operating expenses are to be deducted here. Operating expenses excluding depreciation, 75,500. So deducting operating expenses from the sales gives us EBITDA. How much is the amount? 74,500? 74,500. Now from this we have to deduct the depreciation expense, which is given, less depreciation and amortization. So this amount is given, 10,200. So we get EBIT. EBIT is 64,300. Now from this EBIT we have to deduct the interest charges. So less interest. From EBIT we have to deduct the interest. It will give us EBT. So how we can calculate the interest? The bonds are 16,500. Rate of interest. Rate of interest is 7.25%. So interest 16,500 multiplied by 7.25. So this amount is 1196.25. So interest on bonds is 1196.25. 1196.25. Deducting interest from EBIT gives us the earning before tax or the taxable income of 63,103.75. Okay, now from this we have to deduct the taxes from EBT, earning before tax, which is 63,103.75. We have to deduct the tax. The rate of tax is 35%. So 35% of this amount, 63,103.75, 35% of this amount comes to 22,086.31. So now the net income finally is 41,017.44. So that is the net income for this company. I hope this is clear, this example. Only there were two things that needed to be calculated other than the normal formula. We just calculated the interest. The calculation of interest is the amount of loan multiplied by the rate of interest, and then we calculated the tax, which the rate was given. So whatever is the taxable income, 35% of that was the tax.
Tax on the EBT. Why didn't we deduct it from the sales?
No, actually this is income tax, so it has to be on the income, net income, not on the sales. The tax that we already discussed, the tax which is deducted on the sales, that is sale tax, that is different. Okay, next is question number 9 is about statement of retained earnings. Statement of retained earnings. Statement of retained earnings shows us what is the changes in retained earnings that take place during a particular year. This is a very simple statement. The format for this is we have to mention the opening balance of retained earnings, means whatever was the retained earning at the start of the financial year, that has to be mentioned here. Then in this opening balance we add net income earned during the current financial year, that has to be added in this opening balance of retained earning. And now from this we deduct the dividends. So if the company has paid any dividend during the current year, that has to be deducted to find out the ending balance of retained earning. So this is the format for statement of retained earnings. We need to know the opening balance, what was the retained earnings at the start of the financial year, then whatever net income we earned during the current financial year, it has to be added into it, and then we deduct dividend for the current year from this amount to get ending balance of retained earning. Now in this question, it is mentioned that on December 31, 2012, Height Industries reported retained earnings of 5,25,000 on its balance sheet, and it reported that it had $135,000 of net income during the current year. On its previous balance sheet at this December 31, 2011, the company had reported $445,000 of retained earnings. So this is the opening balance of retained earning. $445,000 is the opening balance. The balance sheet on December 31, 2011 showed this balance. So that was the retained earnings at the start of 2012. No shares were repurchased during 2012. How much in dividend did the firm pay during 2012? Now in this case we have to find out the dividend. The opening balance is given, then net income is given, which is 135,000. And then ending balance of retained earning, which is the retained earning as on December 31, 2012, $525,000 is given. Now we can find out the dividends which are missing. We have to add up these two and then subtract from the total this $525,000. So opening balance plus net income, we add them up together and then deduct the ending balance. Whatever is the difference, that would be the dividend. So in this case it comes to be $55,000. So dividend is $55,000. So in order to find out any missing item, if the statement of retained earnings is in the question, we just put the format together and we can find out any missing item. For it can be net income, or if it is dividend or ending balance of retained earnings, any of these missing item we can find out. But in case if it is only one value, not more than one value. ठीक है, एक कोई मिस होगा तो कर लेंगे, एक से ज़्यादा होगा तो फिर तो आप फाइंड आउट नहीं कर सकते. Okay, now the last question number 10 is about EVA, which is economic value added. Question number 10. EVA stands for economic value added. Anyone would like to mention what is EVA, what is economic value added? Any rough idea? So the basic idea was in economic value added that whatever income we earn during a particular year, if we deduct the cost of capital from that, so that would be our real earning, or that would be economic value added during a particular year. So that is one of the measure which is used to find out the performance of the company, that how well the company is performing. So for comparative purpose. Now the formula for EVA again is NOPAT minus weighted average cost of capital multiplied by total investor supplied capital. So net operating profit after taxes, from this we are deducting the cost of capital, whatever is the total cost of capital. Now in this the question number 10, it states that Scranton Shipyards has $20 million in total investor supplied operating capital, and its weighted average cost of capital is 10%. Scranton has the following income statement. The income statement is mentioned: sales less operating costs, then EBIT, from that interest expenses that is deducted to get earning before taxes. Taxes are deducted to get net income. Now the question is, what is Scranton's economic value added? So for calculating economic value added, we need to find out NOPAT first, which is equivalent to EBIT 1 minus T, whereas weighted average cost of capital is given, which is 10% multiplied by investor supplied capital is 20 million. Now EBIT is 4 million. Tax rate is 40%, so 1 minus T 6%, 1 minus 0.4 minus 20 million into 0.10. So the NOPAT is equivalent to 2.4 million, and the cost of capital is 2 million. So EVA is 400,000. The basic purpose is,
This factor means what?
okay, basically what we are doing is this part is if we have to if we are, let's suppose if we are not investing this money in our business, we are investing this money in some other business. Okay? So we are investing this money in some other business, we have this 20 million available with us. If we invest in some other business, we can earn this much, 10% we can earn on it. It means minimum we can earn is 2 million with this amount, whereas we have earned 2.4 million. So this 400,000 is the amount which is over and above what we would have earned somewhere else. So that is real economic value added by the management. This is the real contribution by the management, that this amount they have earned over and above of what they would have earned by investing this money somewhere else. Okay, with this, chapter number 3. Last time we covered the theoretical part. This class we covered some of the practicals.
What does weighted average?
Okay, the agenda for today's lecture, that the topics we are going to cover is ratio analysis, DuPont equation, effects of improving ratios, limitations of ratio analysis, and qualitative factors that should be considered while we are doing analysis of financial statements. Okay, since we are going to do the analysis of financial statements, we need some figures for that. So these are the figures which are given. This is a balance sheet, and now once we are going to do the analysis of financial statement, at least we need the financial statement for past 2 years. In this case, they have given us the balance sheet. These are the assets which are given, total assets. Now the cash for 2012 as well as the 2013 is given. Account receivables for 2 years is given in this. Inventories, all these added together comes to total current assets. Then we have fixed assets. Gross fixed assets mean they are the depreciation is not deducted from those. From gross fixed assets, there is deduction of depreciation, and that gives us net fixed assets. So when we add total current assets and net fixed assets, we get total assets. So in this slide, the total assets are mentioned for 2 years so that we can do the analysis. Account receivables.
And what is this 2013 ending?
Expected. Again,
foreseen and this is expected.
foresee, forecasting, yes, forecasting. Now again, balance sheet is continued here. That was about assets. This slide shows about liabilities and equity. So in current liabilities, we have accounts payable, notes payable, and accruals. Notes payable are mentioned here in current liabilities because these might be short-term notes payable. Then in long-term debt is mentioned separately. Long-term debt means it is payable after 1 year. Then common stock, these are the shares which are issued, and then retained earnings. These are mentioned. Common stock plus retained earnings gives us total equity. So total debt and equity, that should be equivalent to the assets. So here you can see total assets is 3.4 million for 2013, and total liabilities and equities is also the same amount. So we need balance sheet for 2 years, plus we need income statement for 2 years. Here in this slide, the income statement for 2012 and 2013 is mentioned. So this is the data given. Now based on this data, what we will be doing the ratio analysis. क्या करा? Right. Analysis we are going to do now. This is just the. No, we are not doing it. This is just the data that is given. Now, based on this data, we have to do the analysis. Okay, this is other data, some other data for which will be helpful for us for doing the analysis. Number of shares, there were 100,000 shares outstanding in 2012. In 2013, it reached, the number of shares increased to 250,000. Earning per share was negative. It means there was loss in 2012, but there is a profit in 2013. Dividend per share was 0.110 in 2012. In 2013, it is 0.220. Stock price, obviously you can see the difference. In 2012 it was $2.25. Why? Because there was a loss. But since the performance increased in 2013, the price of the stock also increased from 2.25 to 12.17. Okay, that's a good question. Earning is total income divided by number of shares. Now obviously you are not going to give the entire income as dividend to your shareholders. You are going to retain some portion of it. So that dividend per share shows actually how much you have paid to the shareholders. So out of total income, that might be because of the previous year's performance. That might be because of previous years. Normally, your question is right. Normally, once there is a loss, there is no dividend. But it might happen that in the previous years, the company was performing very well. So, in continuity to that,
We have given it from the retained
from the previous years, right? Previous period, right? And then the lease payments are same for both years. Okay, so why we use this ratio analysis? What is the need of this ratio analysis? First of all, if you go by the numbers, if you look at the normally what you are interested in, or a person, a normal layman who's not very well conversant with the financial statements, what he will be looking for? Normally he will be looking for net income. That what is the net income of the company? Now, that just looking the bottom line or the net income will not give you true picture of how the company is performing, because it will not depict the liquidity of the company, that how well, how strong financial, whether the company is in strong financial position or whether it is in weak financial position. Similarly, it will not reflect upon the performance of the company as far as its asset management is concerned. So that is why we look into these ratios instead of looking at absolute numbers. Another thing is, if you look at absolute numbers, obviously the company which is big, like it has huge capital involvement in it, so the numbers will be higher in each and every part in that company as compared to the other company in which the invested capital is less. So based on absolute figures, you will not be able to judge the performance of both the companies. So for that purpose, we standardize the numbers, and we to facilitate that comparison, we use ratios instead of absolute numbers. And these ratios, as in the course of these slides, you will see that these ratios are helpful in highlighting the weaknesses as well as the strengths of the company.
It is not essential that it should be comparable to a company, but it can be also time off. For example, what they perform in 2012 compared to 13.
That is what is mentioned in the next slide, that how these ratios can be used. Trend analysis, obviously you can see the trend, how the company is moving along year to year, that is trend analysis. It can be, if you have industry averages available, like based on the whole industry, how an average based on whole industry, that is called industry average. So if you have industry average, you can compare a company's ratio with that industry average to see how the company is performing as compared to the entire industry. And then you can also do the comparison, firm to firm comparison on that as well. So these three types of comparisons can be done.
Industry average also.
Industry average, like if you have chemical firms, now if there are 8 chemical companies which are working in that industry, the ratio of all these combined, that will be industry average.
And what are benchmark?
Benchmark can be if any company is declared, like if it is found that that company is performing maybe outstandingly out of all the companies, that can be made a benchmark. Okay, this is the benchmark. Now how this company is performing compared to this benchmark. Or it can be firm to firm comparison between 2 or 3 firms together, that can also be done. Okay, now these are the 5 major categories of ratio that are generally used, or we are going to see in these slides. One is liquidity ratios. Liquidity ratios tells us that whether the company is able to meet its short-term financial requirements, whether the company has the ability to pay off the debts. So that shows us, these liquidity ratios gives us this idea that whether the company is liquid enough, whether it has sufficient funds to meet its obligations. Second is asset management ratios. Asset management, how the assets are utilized, how well the assets are being utilized to generate the sales. So right amount of assets versus sales. Third type of ratios that are generally calculated shows us the debt management, how well the debt is being used. The company has financed through borrowing, and how the company is using that money, how well the company is using that money, this is reflected by debt management ratios. Profitability ratios. Profitability ratios shows us that what is the return that is being generated from the investment. Like you can see here, profit margin What is the profit margin if there are total sales, like let's suppose if it is 100 million shares, so out of 100 million, what is the profit? Profit margin shows us this. Return on equity, that whatever amount the shareholders have invested, what is the return compared to that investment? And then return on assets. So the total amount of assets compared with the net income. So profitability ratios, and then the fifth category is market value. So do investors like what they see as reflected in price earning ratio and market to book value ratio? So market value ratios gives us that how the investors can look into the performance of the company. So these are the 5 major categories that of ratios that are calculated: liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and market value ratios. The data we showed in the beginning slides, based on that we'll calculate all of these.
What is the last one?
Price earning ratio, that is market price of the share divided by the net income, and then market value divided by the book value of the share. Okay, now first of all, starting with the liquidity ratios. The liquidity ratios, the ability reflects the ability of the firm to meet its obligation. 2 ratios are generally calculated to determine the liquidity of a company. One is current ratio. Current ratio is your current assets divided by current liabilities. Current assets divided by current liabilities. Now the current ratio here is $2,680 divided by $1,145 of current liabilities. That gives us current ratio of 2.34 times. So it means the current assets of the company are 2.34 times of its current liabilities. Almost, you can say, double or more than double of the current liabilities. Ideally it should be 1 to 2. So 2 in general terms is a good current ratio. You have double, your current assets are double of your current liabilities. Now again, just looking at a ratio cannot tell us whether it is good or bad. It will become meaningful when we do some comparison, whether we do current analysis, trend analysis, whether we compare it with the industry average, or whether we compare it with some benchmark. Only then we can find out whether this current ratio is good or not. Now quick ratio, another ratio which is calculated to find out the liquidity of the company. Quick ratio is a little more stricter as compared to current ratio. The only difference between current ratio and quick ratio is, in case of quick ratio, we are not including inventories in current assets. We are taking off inventories. So current assets minus inventories. Why we are taking off inventories? What is the reason?
So their impact will become later on.
Out of all the current assets, these are the slowest moving. Inventories are the slowest moving of the current assets. So that is why we are taking off that impact, their impact out of the current assets, and then we want to see what is the position. Now if you take out, in this case, when you take off this inventories, your quick ratio is 0.84. So it means inventories the inventories in this case are more than 60% of your total current assets, which is a very big number, very big percentage. 60% of your current inventories is your stock that you are going to sell, unsold goods.
So the slow moving कैसे हो सकता है? आपका कारोबार ही वही हो गया that is being sold next day.
But out of all other, like cash, account receivables and inventories, compared to all others, this is the problem. The problem can occur only in inventories, not in cash, not in it. That is the only problematic out of the all current assets.
Actually, it is an expected value, so it may hold down or it may go up and not be calculated in the
Inventories? Okay, now as I said, just looking at the numbers will not give you any idea. Now here is the comparison. Two type of comparisons are done here. One is that the trend analysis is there. You can see the current ratio for 2011, 12 and 13, 3 years. And then comparison with the industry is also there. So in case of current ratio, you can see that it is below the industry. average. Industry average is 2.7, whereas the current ratio for 2013 is 2.34. So it is below industry, but it is improving, because in 2011 it was 2.3, in 2012 it was 1.2, and in 2013 it improved a bit. So it is improving, but it is still below the industry average. As far as the quick ratio is concerned, quick ratio is also below the industry average. So based on that we can say the liquidity position is weak. Okay, this is how, like, ratios will give you some idea that what is going on and what are the strengths and weaknesses. The ability of the company to pay off its debts in the short run. Like what we are looking at is current liabilities. Immediately what are due, what are our loans which are becoming payable. ठीक है, तो अब हम ये देख रहे हैं कि हमारे पास क्या इतने रिसोर्सेज हैं कि हम वो जो हमारे शॉर्ट पीरियड ऑफ टाइम में हमारे लोन्स पे होने वाले हैं, क्या हम उनको पे कर सकते हैं कि नहीं कर सकते हैं. Right, we have the value for industry average as well available. ठीक है, हमारे पास थी, तो हम उसके साथ उसको कंपेयर कर रहे हैं. Which one? 2 times? Because if you look at the quick ratio जो थी, that is, it means, as I already mentioned, out of the total current assets, 64% is your inventory, and inventory can be a problematic thing as well. Yes, quick ratio 1 to 2 is generally it is good. It should be between 1 to 2. Quick ratio should be between 1 to 2. Okay, another ratio that can be calculated. Quick ratio means you have twice. Again, just saying that it is 1 to 2 is not. Again, you have to see the industry, compare with the industry how well you are performing. And if you have an industry average, then you can see that where do you stand. In generally it is. Strong liquid position. No, it means that your current assets are at least double of your current liabilities. So it means if you have whatever is coming in short period of time, you have enough resources to pay off that. The current assets, right?
As compared to the expenses or liabilities.
Current liabilities, yes, as compared to current liabilities. Inventory turnover. Inventory turnovers tells us that how many times the inventory is converted into cash in a given year. So in 1 year, how many times the inventory is converted into cash. Now in this example, the sales are $7,036, whereas the inventories are $1,716. So dividing,
So 7,000
and yes, sale for the whole year. So sales divided by inventories gives us inventory turnover of 4.1 times. It means their inventory is converted, the inventory of this company is converted into cash 4 times a year. Now, is it good or bad? Again, we have to look into the trend analysis as well as with the industry. The industry average is 6.1 times, so it is far below than that. Industry average for inventory turnover is 6.1, whereas the inventory turnover for this company for 2013 is 4.1 times. And you can see also it is deteriorating, it is decreasing. Like in 2011 it was 4.8 times, in 2012 it became 4.7 times, and in 2013 it again decreased to 4.1 times. So
How can we say the inventory has turnover? Because it's going to be consistent in the production.
right.
So is there some benchmark or the
No, again, as I mentioned, told you earlier, that how we'll calculate the industry average. Like if there are 10 firms.
If you don't consider that. So this is saying that the inventories are
Right.
outstanding 50. So is it the total cost of the inventory when it comes to your current assets?
Right.
That is why it has to be done.
The inventory that we have in our current assets, that is the value 1716.
So we have actually compared the total sales with the inventories that are currently available.
Right. That's it.
That is how we get the revenue.
Right.
Currently available or currently sold?
नो अवेलेबल, सोल्ड तो वो तो सेल्स में चला जाएगा ना, जो सेल वो तो सेल्स में चला गया, जो सेल नहीं हुई उसकी बात हो रही है, अवेलेबल वो इसमें आएंगे. अब इसकी बेसिस पे हमने हाउ वी कैन इंटरप्रेट दैट, व्हाट इज द कमेंट्स ऑन दिस. इन्वेंटरी टर्नओवर इज बिलो इंडस्ट्री एवरेज दैट वी सॉ, इंडस्ट्री एवरेज वाज 6 times and it is 4 times. Delon might have old inventory or its control might be poor. So the only thing that we can guess from this is that either the inventory is old, it is not moving, or either the control over inventory is not very strong. So no improvement is currently forecasted. Why? Because we can see the trend, it is decreasing, 4.8, 4.7, 4.1. So it is going downwards, not upward. Okay. हाँ, मतलब वो पॉइंट वही है कि what is the reason? Either they have old inventory, so get rid of those inventories, or improve your control over inventories. So inventory management is the issue. Inventory management is the issue. That is the issue.
There might be some dead inventory also
Available. So
which is not, which the company cannot get it out.
वो that बिल्कुल वो इसी तरह है. So
Last time I have no improvement is currently forecasted.
हाँ, मतलब इसकी बेसिस पे तो हम फोरकास्ट नहीं कर सकते. वो जा रहा है डिक्रीजिंग.
We cannot suggest any improvement.
नहीं सजेस्ट तो कर सकते हैं, लेकिन
नीचे जाता जा रहा है ना.
तो फोरकास्ट नहीं कर सकते इसकी बेसिस पे.
You cannot forecast an improvement because it is going down.
सो यू नीड टू इम्प्रूव योर इन्वेंट्री मैनेजमेंट, फिर ये इम्प्रूव हो सकता है. प्रॉब्लम हमने आइडेंटिफाई कर लिया कि
ये forecasted है.
फोरकास्टेड
For 2013 it is forecast.
and yes expected. So basically if the same policies are there, no improvement will be there. We need to improve our inventory management, only then it can improve. Okay, days sales outstanding, DSO, days sales outstanding, that is average number of days after making a sale before receiving cash. So you are selling on credit, how many days it takes you to get cash. ठीक है, बेसिकली आप ये कह लें कि आपकी क्रेडिट पॉलिसी क्या है, कितने दिनों में आपको कैश मिल रहा है. सो यू कैन कैलकुलेट दिस डे सेल्स आउटस्टैंडिंग बाय डिवाइडिंग रिसीवेबल्स विद योर एवरेज सेल्स पर डे. एवरेज सेल्स पर डे इज इक्विवेलेंट टू एनुअल सेल्स डिवाइडेड बाय 365 number of days in a year. So day sales outstanding for this Delon company is 45.6 days. So they are basically receiving cash against their credit sales in 45.6 days. Again, now we have to see whether account receivables.
And how much time? For whole year?
Yeah, this is for the whole year.
Whole year में this much amount is yet to be received.
This is still outstanding. So this is to be received, and then out of the total sales, because we have taken annual sales, so out of annual sales, this is the receivables. These are not yet collected. So compared to annual sales, if your total sales were $7,036, maybe it is $1 million or whatever, out of that is $878 million are yet to be received. So that
ये एनालिसिस नहीं करते कि हर 45 डेज के बाद हमारे पैसे वापस.
यही है, बिल्कुल इसी को exactly that is what it is. That every your credit sales are converted into cash in 45 days. 45 days. Now let's see. These are outstanding credit sales, receivable or credit sales. So basically you are comparing your credit sales with your total sales or sales per day. So
Average I have calculated, I would see, okay, 7,000 is the net income. And I have got 65 days.
okay.
So it's going to give me a straightforward how many days it takes for me to get the receipt like that.
No, but that is sales per day. You are dividing total sales, not credit sales, total sales with the number of days. So that is your sales per day. Now sales per day, that amount that you are dividing with your receivables to see how many days it is taking your receivables to collect. So as far as day sales outstandings are concerned, industry average is 32 days. 30, in industry average is that the account receivables are collected in 32 days. And if you look at this company's figure in 2011, it is 37.4 days, in 2012 it is 38.2 days, and it is worst in 2013 when it is 45.6 days. So we can conclude that Delon collects on sales too slowly and is getting worse. Delon has a poor credit policy. No, but let's see. Let's see. Let's see. Maybe the company has strength in other areas. So these two areas are weak, we have identified, but let's see. Now, fixed asset and total asset turnover ratios versus the industry average. Fixed asset turnover. How efficiently your fixed assets are being utilized to generate sales. So that you can find out by dividing sales with the net fixed assets. Net fixed assets mean fixed assets minus depreciation. So sales divided by net fixed assets gives us fixed asset turnover of 8.61 times. Whereas the total asset turnover, when we divide sales with the total assets include our current assets as well as fixed assets. So it gives us 2.1 times.
So sir, fixed assets turnover, they indicate how efficiently the fixed assets are utilized to generate money.
Generate sales.
Generate sales.
Right.
And what about the second term?
Total assets, how efficiently the total assets are used to generate sales. So in one, we are just taking or comparing the fixed assets. In the other, we are talking about the total assets, including our current assets as well. Very? Which one?
It is the net fixed asset of the company
Mm-hmm.
minus the liability.
Depreciation.
So this should be a big number.
It should be a big number.
Fixed assets, the net fixed asset of the company.
Depends. Obviously, sales are also high. So 817 का फर्नीचर 817 वो मैंने अगेन कहा कि मिलियंस भी हो सकते हैं, पूरे साल का आप ले रहे हैं तो इट विल बी इन मिलियंस और बिलियंस, वो हमने आगे जीरोस मिलियंस में, हाँ बिल्कुल होंगे, डिपेंड करता है अब. Okay, what would you say about let's say Coke? But what about sales? What about sales?
I think so. It should be not more than I would grade 1.25 or 1.5. Not more.
Coke, one because
factory can't be cost. So
ठीक है, ठीक है. बट सेल्स भी आप देखें ना उसकी. केमिकल कंपनीज, आप केमिकल के जो प्लांट्स हैं उसमें कितना फिक्स्ड एसेट होगा? नहीं, लेकिन उनकी जो, ये मैंने इसलिए कोक की आपको एग्जांपल दिया है, कोक उनकी डेली की सेल्स जी, सॉफ्टवेयर कंपनीज आप देख लें जी, हाँ उसके फिक्स्ड एसेट्स क्या होंगे? नथिंग, बट सेल्स आर इन मिलियंस. Total assets, sorry, fixed asset minus depreciation. Minus depreciation.
जो net fixed assets.
Net fixed asset.
And total assets में depreciation शामिल है.
नहीं, वही net fixed assets plus current assets. उसमें current assets भी आ गए ना. Current assets भी आ गए. पहले वाले में current assets शामिल नहीं था. बस ये last slide पे. Okay, now let's see how these two ratios compare to the industry as well as over the years. Fixed asset to total asset, industry average is 7 times. This company had 10 times in 2011, 2012 it decreased, but again it improved in 8.6 times. So fixed asset turnover projected to exceed the industry average. It remained above industry average at least in 2 years, in 2011 and 2013. हाँ, वो तो लॉस हुआ ना. Because the figure you can see is 8.6 times. ये हाँ, वो एक्सपेक्टेड ही बता रहा है कि एक्सपेक्ट, हम प्रोजेक्ट यही कर रहे हैं कि इट विल एक्सीड, प्रोजेक्टेड फिगर है ना, एक्सपेक्टेड, सो इट विल बी
नीचे जाता है ना,
नहीं,
मैं 2010 के उस टाइम
हाँ इट इज एक्सपेक्टेड टू एक्सीड, मतलब अगर 8 भी है स्टिल इट इज बेटर देन इंडस्ट्री एवरेज, 7 से ऊपर है ना। 3 में से 2 साल तो इंडस्ट्री,
ऐसा पॉइंट ऑफ व्यू था कि मतलब 2011 से 2012 में if you gain, there has been a decline.
फिर अगेन 2012 से 13 में इंप्रूव कर गया।
चूंकि वो expected है, it has not yet come.
हाँ।
How can they, have the company taken certain measures?
ऑब्वियसली मतलब एक्सपेक्टेड उन्होंने किया है, तो बेस्ड ऑन सम फोरकास्टिंग उन्होंने की है, बेस्ड ऑन सर्टेन फैक्ट्स एंड फिगर्स किया है ना, तो उसकी बेसिस पे यस इम्प्रूव करेंगे। Okay, now fixed asset, so total asset turnover. Total asset turnover, as far as industry is concerned, it is 2.6 times. So this company's total asset turnover is less than industry, and you can see total asset turnover below the industry average. It could have been due to excessive current assets, which is account receivable and inventory. We have already seen this, that inventory is high for this company, and again account receivables could be high. That is why this total asset turnover is below the industry average. So this is this little bit of analysis can highlight that how specifically we can find out what are the strengths and weaknesses of a company.